Hey, this is Chris, and in this video, I'm going to be sharing my 3 tips for passive investors. So first of all, what is passive investing? Well, it's generally a buy and hold investment strategy for the long term where you're doing minimal buying and selling. So you're not actually that active in the investment strategy. It's broadly the strategy we recommend at StockSpot because passive investing is less complex and all of the evidence seems to support that it actually gives you superior after-tax returns over the long run. So it is a good long-term investing strategy. Now, my 3 tips for passive investing are, first of all, you should always be tax aware. Now, this isn't just for passive investors, but it's particularly important for passive investors because one of the great benefits of investing passively is that you're deferring tax. So whenever you're considering selling when you're a passive investor, you should be considering the impact of tax. Selling may give you an opportunity to buy back lower, but having to bring forward that tax liability, it has a pretty negative impact. So it may delay your thinking on when you should be selling. It's something also to be thinking about when you're rebalancing your portfolio. Now, we recommend rebalancing at StockSpot when one asset moves a long way away from its target weight. Ideally, if possible, if you can be using top-ups or contributions to rebalance your portfolio rather than selling, it's going to have a positive impact and reduce your amount of tax that you're paying along the way. Now, my second tip for passive investors is that you still need to diversify across different asset classes. I do see some passive investors out there that simply buy one ETF. They'll buy one index fund that tracks one market. And while this can work out over the short and medium term, what tends to happen is that asset classes have periods of good and poor performance, over many years. And if you're only invested in one asset class or one share market, you may be missing out on opportunities in other markets, but also not enjoying the benefits of more smooth returns if you're spreading that money out. So while you want to be passive, there is still some benefit into investing into different markets to smooth your returns. Now, my final tip for passive investors is that you should be checking your portfolio not very often. I mean, it's a tip that comes up in a lot of my tip videos, I think, but particularly for passive investors, I think it's a bit of a contradiction where passive investors are updating their portfolios daily or checking on their portfolios daily. There's really no need to check in on how things are going on a daily or weekly basis. If you're a true passive investor, I think the regularity of checking your portfolio should be not more often than once a month. That's going to set you in the right mind frame and also prevent you from being tempted to buy and sell too often. And they're my 3 tips for passive investors.